And Jeffrey Gundlach joins me now for a CNBC exclusive interview. It's good to be back here in Los Angeles with you.
Indeed. Welcome back. It's been a long time.
It has. We continue our streak of Fed days with you. Your reaction to the decision when you were with me in June, you said, quote, I don't think the Fed is going to raise rates again. Yet here we are.
Yep, they raised again. And obviously the bond market was way ahead of this. I mean, the WARP function, which gives you a probability from the shape of the short and the yield curve, was over 99%. And I don't think we've had a meeting really since this all started where there's unanimity of opinion that there was going to be a hike, but that there wasn't even any debate that it was going to be 25 or 50. So they're obviously slowing down. The yield curve remains inverted. It de-inverted there in the aftermath of the regional banking problem with SVB, and that was a real recessionary sign. That was a moment where the markets were getting pretty nervous because the recessionary signals really, you get on watch when the yield curve gets very inverted. But as was brought up in some previous guests on your network today, it's when it starts to de-invert that you really get worried. And that stopped happening once the bank crisis calmed down. So the de-inversion is what you have to look for, and it hasn't really happened. I mean, we're back out at about 100 basis points, 2s, 10s, and we're really inverted from the 3-month bill to the 10-year treasury. So we're watching for that. We're also watching for the gap between consumers' views of the present start to deteriorate and meet up with sort of what they have a view of the future, which is almost always on the pessimistic side. It's kind of weird. They always think it's going to be a little worse in 12 months. That has started to narrow a little bit, but not enough yet. So the other thing that's really important, I think, why I thought that the Fed wouldn't raise rates, and I think they shouldn't have. I kind of agreed with David Kelly, who was on right before I think the statement was announced, that they have the right to be and a reason to be careful here. And we've been talking about this the last few appearances I did with you, that inflation is coming down. And the headline CPI went from 9.1 to, I mean, people say it's 3, but amazingly, it actually has a 2 handle. If you go to the 2 decimal points, it's 2.98. And there's big numbers rolling off for the PCE, particularly the core PCE, in the next 3 to 4 months. It's possible that the PCE could go down to a 3 handle on the core level, really this coming month, because there's a big number rolling off. And that the headline PCE, which nobody really talks very much about, but it could go down into the 2s fairly soon. So we believe that the inflation rate is pretty much where the Fed should really be happy with where it is right now. You know, I did a funny study. I said, we keep getting this rhetoric of the 2% average inflation rate over time. Do you know what the core CPI average over the last 20 years per annum? 2.0%. It's exactly there. So we're exactly there. And if you took headline CPI and replaced the owner's equivalent rent, which is a big slug of the headline CPI, if you replaced it with actual home price movements from these indices, the CPI would not be 2.98% on the headline. You know what it would be? 0 if you replaced owner's equivalent rent with home price appreciation. So I think the Fed should take David Kelly's advice and try not to, just be on a programmatic sort of a situation, because the data seems to be getting a little bit better.
What I hear you saying is that the Fed should declare victory, in a sense, out of this whole thing and go home. That they shouldn't hike anymore because they don't need to.
I don't think they do. That was kind of my point of view when we spoke last time.